It was everywhere. A household name, stores on every corner, ads on every channel, products in millions of homes. But today, silence. Stores closing, revenues plummeting, market relevance slipping. The answer isn't one mistake. It's a perfect storm of changing consumer behavior, online disruption, and internal mismanagement. Welcome back. Today we're uncovering the silent collapse of a global retail empire. This isn't just about failing stores. It's a lesson about how even the biggest companies can crumble if they ignore trends, technology, and customer trust. We'll explore how this empire rose, why it fell, and what it teaches businesses and consumers about the modern retail world. 1. The rise of the empire. At its peak, this retailer dominated the globe with hundreds of stores, exclusive products, and aggressive marketing. It thrived on brand recognition, mass market appeal, and physical stores in every neighborhood. Customers trusted it implicitly, its products, services, and even its pricing. The empire also leveraged bulk purchasing and global supply chains, allowing competitive pricing that drove smaller competitors out of business. At the time, e-commerce was a novelty, and executives believed foot traffic alone would sustain growth. 2. The digital blind spot. The first critical misstep? Underestimating the rise of online shopping. While competitors invested heavily in e-commerce platforms, this retailer remained focused on physical stores. Its website was slow, clunky, and lacked seamless shopping or mobile integration. By the time it tried to catch up, customers had already migrated to Amazon, Alibaba, and other online giants. The digital blind spot became more than inconvenience. It eroded customer loyalty and market share. Younger generations, accustomed to convenience and instant delivery, had no reason to return to physical stores. 3. Competition adapted faster. Even traditional competitors recognized the shift to online-first strategies. Discount chains, niche brands, and subscription-based services offered seamless e-commerce experiences. Fast, affordable shipping, personalized recommendations. Consumers no longer needed to walk into a store. They could compare prices, read reviews, and receive products at home. Meanwhile, the retailer's reliance on store traffic and mass marketing became a liability. 4. Internal mismanagement. The empire's internal issues accelerated its decline. Overstaffed stores with high operational costs, inefficient supply chain causing overstock or empty shelves. Leadership focused on short-term profits instead of long-term strategy. Employee morale suffered, leading to high turnover. Innovations that could have modernized operations were ignored or underfunded. The culture of complacency allowed smaller, agile competitors to gain market advantage. 5. The pandemic effect. Then came COVID-19. Lockdowns and social distancing slashed foot traffic, hitting an already struggling company hard. Online competitors thrived while physical stores faced closures, layoffs, and plummeting revenue. What was already a slow decline became a sudden, irreversible drop. 6. Mounting debt and financial strain. The retailer's heavy debt load compounded problems. Expensive leases, supplier contracts, and operational overhead strained cash flow. Investor confidence dropped. Attempts to restructure and cut costs came too late, and bankruptcy became a looming threat. 7. Losing touch with customers. One of the silent killers of the empire was losing touch with consumer behavior. Younger customers gravitated toward brands that offered personalized experiences, social engagement, and convenience. Loyalty programs, mobile apps, and curated content left the giant behind, unable to connect with evolving consumer expectations. 8. Strategic miscalculations. The retailer overinvested in physical expansion while neglecting innovation. New store openings were expensive, poorly located, and underperforming. Meanwhile, investments in digital infrastructure remained minimal and fragmented. Executives underestimated the speed of market change and overestimated brand loyalty, assuming customers would return despite convenience, choice, and pricing available elsewhere. 9. Lessons for businesses. The collapse teaches several key lessons. Adapt or die. Rapid digital disruption cannot be ignored. Know your customer. Failing to evolve with consumer behavior is fatal. Financial prudence matters. High debt accelerates vulnerability. Culture and innovation are critical. Complacency erodes competitive advantage. These lessons apply to businesses of all sizes and even to individuals navigating a changing economy. 10. The future of the brand. While the empire may be collapsing, some remnants pivot online or target niche markets. Success requires digital-first strategies, consumer engagement, and bold innovation. The clock is ticking. The longer the delay, the harder recovery becomes. 11. Case study, Sears. The fall of a legend. Sears, once a titan of retail, provides a striking example of a global retail empire slowly collapsing. Sears failed to adapt to online shopping, continued expanding stores instead of modernizing, and suffered from internal mismanagement. Its loyalty programs and catalogs, once revolutionary, were no longer enough to retain customers. By the time it invested in e-commerce, competitors like Amazon and Walmart had already captured the market. Even iconic brands can collapse quietly over years, leaving customers, employees, and investors surprised when the fall becomes undeniable. 12. Toys R Us, ignoring the shift to digital. Another cautionary tale is Toys R Us. Once the go-to destination for children's toys, it filed for bankruptcy in 2017. The company relied heavily on large stores and seasonal foot traffic, while online retailers offered cheaper prices, faster delivery, and more variety. A massive debt load from leveraged buyouts further weakened its ability to invest in technology and marketing. Tretton, Forever Inognitive Fast Fashion's warning. Fast fashion retailer. Forever 21 also illustrates how rapid expansion and poor financial planning can accelerate collapse. By opening hundreds of stores globally without integrating online channels or inventory automation, Forever 21 struggled to adapt to changing consumer behavior and digital competitors. The result, store closures, layoffs, and restructuring under bankruptcy protection. These examples show a pattern. Reliance on physical presence, delayed digital adoption, overexpansion, and financial missteps can silently erode even the most powerful brands. 14. Stock market and investor reactions. As these retail empires struggled, investors in the stock market reacted quickly. Stock prices of struggling retail giants often decline long before store closures make headlines, signaling that financial markets anticipate the fall earlier than the public. Analysts cite falling same-store sales, declining foot traffic, and increasing debt as early warning signs. This demonstrates that the collapse isn't sudden, it's years in the making, with subtle financial and operational warning signs missed by casual observers. 15. Executive decisions that accelerated collapse. Leadership choices often make or break these empires. Common missteps include overconfidence in brand loyalty, assuming customers will stay no matter the competition. Neglecting innovation, delaying investment in e-commerce, logistics, and data analytics. Cost-cutting instead of strategic investment. Reducing marketing or technology spending at the wrong time. Executives often prioritize short-term profits over long-term transformation, underestimating the pace of market change and consumer expectation. The silent collapse of a global retail empire is a warning. No brand is too big to fail. Businesses must adapt, innovate, and stay connected with consumers or risk disappearing quietly while the world moves on.